it's been a really scary week. We're going to come to that a bit later. But for all the viewers, run us through, what is a bond and what's the difference between bond and equity, for example?
Yeah, I mean, there's two main types of bonds. There's government bonds and there's corporate bonds. Essentially, what a bond is, it's a company issuing a bond to raise capital, right, for finance, expansion, investment, etc. The benefit to the company is that it doesn't have to give away its equity in the company. It's a borrowing. For investors, effectively, what they're doing is lending money to that company for a rate of return over a specified period of number of years. Government bonds, on the other side, are effectively the government doing exactly the same thing, but raising financing effectively to fund its spending. I would say that historically, over the last kind of 10 to 15 years, the corporate bond market has actually been mainly driven and accessible by institutions, and that's typically been the case because the minimum trade sizes or denominations are 100,000 plus, and so typically retail investors have kind of been excluded from the wider bond market.
Got you. Why is the bond market considered so important?
Right, so just a little bit of background. From about 2010 to 2020, government bond yields actually came down significantly, from around 4.5% down to, next to nothing effectively. Yeah. So most people didn't really focus on government bonds, and even corporate bonds had, relatively lower yields than they do now. And, since the pandemic, there's obviously been an increase in borrowing by governments. There's been inflation. Yeah. Both of these twin factors have effectively caused bond prices to fall. A higher rate of inflation effectively feeds through into central banks' decisions of interest rates. So most central banks follow kind of an inflation targeting regime. So they, the typical target in the UK was 2%. So if inflation is running at 5, 6, 7, 8%, which it was, from 2022 onwards, basically, interest rates had to rise. Now, when interest rates rise, that obviously makes the existing stock of bonds, less attractive if they've issued at low coupon rates. And so the price of the bonds has to fall in order to make those bonds attractive for investors to actually buy into. What happens is that the kind of rate that investors want to lend money to the government at is at that rate or slightly higher. There's a little bit of a spread.
So like 4.5.
Yeah, exactly. So basically, you tend to see kind of, gilt yields, and yield, it is, what that means is that is the rate of return that investors require in order to lend to the government. Where things can get a little bit choppy, and this is very important for government bond investors, is, if you get caught in long dated bonds, we call this kind of duration risk. So the longer the maturity of the bond, the higher the duration risk. What that means is that if there is a change in interest rates that's adverse to your position, it can cause wild price swings. And so that is exactly what happened to a lot of pension funds in 2022, October, when the government signaled that it was going to increase deficits, spending, and people were concerned about fiscal stability effectively and balance in the books. And so government bond yields spiked out, and the price fell quite dramatically. And those holding 30-year bonds, for example, they got hit the most because effectively, the price has to fall a lot more in order to get to that new yield, that high yield.
And in really simple terms, right, if I buy a 30-year bond that pays me 1% a year, the government 30-year yield interest rate is now 4.5%. That means every single year,
that's right,
that 3.5% has to be made up by the price today.
Exactly.
So if it's over 3 years, it doesn't really matter. But if it's over 30 years, suddenly that price is getting smashed, isn't it?
Yeah, no, exactly right. I mean, we saw 30-year bonds trading in the 30s or 40s when they'd been, trading near par. I mean, literally, that is you can see some wild, moves in prices if interest rates change dramatically. So this is what's actually happened since 2022 in most developed countries, and we're now at a kind of a level where, obviously yields are around 4.5%, and they're, and everyone's, trying to work out they're going to go up, because normally what happens, as we will come on to, in a when people view that there's going to be an economic slowdown, typically a lot of institutional investors view the 10-year rates of some of the developed countries like the US, the 10-year treasuries, as a kind of a safe haven, a more liquid, risk-free kind of asset that they would go into.
Yeah.
But I think, with everything that's going on today, there's a little bit of a concern are things still stable, risk-free? What is happening to the structure of the US economy? Where is debt going? Where are budget deficits going? Are they going to be reined in? There's a lot of geopolitical issues. There's the tariff policy which is going on. So a lot of uncertainty for investors. And so,
And people are starting to talk about a sovereign debt crisis in the US. So what's actually happening there, and what started to happen with bond yields and bond prices last week?
Yeah, so if I step back just to give a bit of context about what's been happening in the US, since about 2000, the national debt in the US has grown from about 5.7 trillion to what it is now today is around 36.5, 37 trillion.
Since 2000?
Since 2000, yeah. So over a 25-year period, basically, the national debt in the US has skyrocketed. And that has been predominantly as a result of, military security and war spending, So basically there's a lot more kind of heightened scrutiny over whether the US's capital structure or its debt load, is sustainable in the long run. And that's part of the reason why people are kind of factoring, is a 10-year really risk-free, or do we need a little bit more juice in the yield in order to take the plunge and buy more of it?
What do you mean by more juice?
Well, higher yield for the higher risk. So basically, the US is perceived as more risky than it has been in the past, simply because of the higher debt load. And then obviously Trump's tariff policy recently has caused a bit of uncertainty in the markets. It was simultaneous, which the markets weren't expecting. So across all countries, the formula was used was actually quite aggressive. So that took the market by surprise. And so that's part of the reason why, yields moved out or moved higher, particularly the 10-year and the 30-year in the US.
When you've got so much debt to refinance, it's like any market, isn't it?
Yep.
You've got to make it more attractive to attract the right number of buyers.
That's exactly right. So, I mean, there comes a point where, economists and, people at the central banks can kind of feel, what the liquidity is for their auctions, what the demand is. And, right now where the US is that people can kind of see, they basically see 1 to 2 trillion per quarter of budget deficits, basically, since the Biden administration came in. The pandemic, obviously, and the spending related to that, but also, some of the other policies which were implemented, the war funding, etc. It's all kind of, shown that, effectively the spending is unsustainable. So this is part of the reason why Elon Musk has made very clear that something needs to be done in order to rein in spending, balance the books, give regaining investors' confidence, in the debt, and so that borrowing costs can come down, because obviously, clearly, what you don't want to do is have to finance your country and your spending at very high rates of interest and never be able to credibly pay that money back. So that's the adjustment is basically what's going on right now.
So basically, if you run a 1 trillion budget deficit per quarter, does that just get added to the total pot, the total debt?
Yeah. So, well, I mean, the interesting thing is that yes, it does, right? So basically, like if you have a gap between what you're spending and what you're getting in terms of tax revenue, right? That's a loss effectively that every year that's added to your and you're funding that through the issuance of debt, right, and money printing, which is at the same time. So basically, your national debt is increasing exactly by that budget deficit every quarter. And if that gets to a point where investors start to think, hang on, this is not sustainable, and there's actually a risk that I might not get paid back on, what I thought was a risk-free asset, and suddenly they're thinking, okay, well, 4% isn't that attractive anymore. I need 4.5%. But it can also get into a runaway perspective where, it can get a lot higher. The US is going through a structural adjustment. It's trying to, get its debt down to sensible levels. It's trying to find ways in order to reduce the debt. The effect of tariffs, isn't just on the countries where you're implementing the tariff on their goods. It's also for US corporates. So if I give you an example, Nike, for example, buys a lot of its shoes from China. Yeah. Let's say it costs $10 a shoe, right? They then sell it up, mark it up, sell it $100. If there is a 100% tariff on that shoe that costs them $10, that's been made in China, they have to make a decision because they're paying that $10 to the US government when they import. They have to decide, are we going to push up prices, to compensate for that extra cost risk, or we're going to take the hit? And in reality, what's going to happen in a slowing market is that it is actually probably, in my view, it's going to be the corporates which take the hit. So what you're going to see is all the sectors which rely on China for cheap, components. The corporates will have to make a decision as to how much their profit they're going to have to sacrifice. So the recent move by Trump to exempt the electronic semiconductors, computers, smartphones, those are important strategic sectors for the US economy because robotics and AI are obviously the future. That's where the competition between China and the US is going to be.
So you mentioned at the start you got sovereign bonds and you got corporate bonds. Obviously, there's a difference in the issuer, but how is the market different? How does the corporate bond market trade?
Yeah, so the corporate bond market is got a lot of diversity in it, right? So with government bonds, you're kind of focused on interest rates, and you're focused on duration risk. That's pretty much macro.
And which government it is.
Yeah, and which government it is. And for corporate bonds, you also have to take into account credit risk of the company. So corporate bonds tend to offer higher coupons, higher returns to attract investors into lending to them effectively and buying their bonds. Okay. And obviously a company can go bust, which is a lot harder, for governments to go bust because they can obviously print money, they can increase taxation, so they have much more flexibility. People have a lot more faith in governments generally. Generally there's a lot more risk in corporate bonds, so you need a higher rate of return to do that. Now, this period of time, what's actually happened is, similar to government bonds, investment grade bonds, which is the lowest risk type of corporate bonds. So they're the high credit, highly rated, from a credit rating perspective, bonds. So investment grade corporate bonds tend to behave, more closer towards, how government bonds behave, when interest rates changes in the economy. Yeah. The high yield bond market, which is actually the most interesting part, which is where you can generate returns in the UK, at least currently, of between 8 and 12%.
To 12%.
Up to 12%, yeah. So a lot of bonds, high yield bonds, which tend to be kind of shorter to medium duration. So there's a lot issued at 5-year, some at 7 and then 10-year, but generally a lot shorter maturity or duration than investment grade or government bonds are issued at. But one of our most popular bonds on our market is the Ocado 10.5% bonds that were issued last year. Over the last year, that stock has dropped 21.3%, over 12 months. There's no dividends paid out by Ocado, but the bond has pretty much traded up or higher than par. This is the classic example. So you've got the stock, which has lost 21%, but the bonds have made you 10.5%. In the UK, it's interesting. If you actually go back through history, so over the last 25 years, if you actually look at the returns, the FTSE All-Shares generated 5.7% a year per annum. According to Barclays, on the investment grade side, it's 4.5% over the last 25 years.
Right.
The same period of time. High yield has generated 9% per annum. So it really is the secret asset class which generates consistent compounded returns over time.
Excellent. Hopefully you'll come back at some point.
Looking forward to it, Rich.